Hello, hello. Hope everybody's having a good day, a good night. We're going to be talking tonight about volume. It's been a hot topic inside of Discord for the last, week and a half, 2 weeks. And although we do have a bunch of volume related content on Circle, we might as well record, probably a 30-minute session here on volume. It's not going to be the full hour because let's be honest, volume is not that sexy or attractive, but I think there's a lot of stuff that we can talk through that'll be productive over a 30-minute session. Look at that in a sec. So first things first, there's a million different ways that we can attack this issue, but I'm going to come out and say it right now. Volume is less important now than it was 20 or 30 years ago. Just going to tell you right now. It just doesn't matter as much, statistically speaking. So I've gone through 2 of the 3 CMT levels, and I was actually trying to look through material to find it, and we were going to read it verbatim. But I can't find it in the damn book now that I have. But the newer statistical studies coming out nowadays for chartered market technicians tend to discredit a lot of the volume work that was popularized in the 80s and 90s. Now, if you think of something like a Stan Weinstein type of stage cycle, if we can come out and let me try to think of something that it broke out. We'll use maybe app, for example. This isn't necessarily a stage 2. It was back here, though, so maybe we can use this. So Stan would be looking not on necessarily a daily time frame, but a weekly time frame. And he would say, listen, I'm not encouraged enough to buy a stock unless there's this huge spike of volume that accompanies the breakout because the statistical odds of the breakout continuing is a lot lower. And back in the 80s, that was absolutely true. He proved it. But now, the advent of high-frequency trading firms, algorithmic trading, etc., a lot of the volume that you see nowadays, specifically intraday, is inorganic. What does that mean? It's just algorithms back and forth trading small, minute changes. It's not as big of an edge anymore to look at volume. So we're going to talk through a bunch of different pieces here, but I'm just going to come out and say it. I'm not the biggest fan of volume. There are certain ways that we can use it, and we do use it in the system, the setups that we have that do have statistical edge, but the overall idea that volume is a crucial element to trading has diminished over time. So we're going to start off first off by just kind of talking through volume, the indicators themselves. Everybody should have or has had a volume histogram. It's generally one of the first indicators that you see when you load up your charting software, the very first time you ever see it. The volume here tells us volume based off of time. So if you change this down to the 1 minute, each candlestick of volume is going to be 1 minute worth of volume. Change it to 5 minute, each candlestick is going to be 5 minutes worth of volume, and obviously we live on the daily, so each daily candlestick is going to be intraday volume. That's what this is. I tend to have a moving average across mine. Sometimes you guys might, sometimes you might not. You can double click your volume histogram. You can actually enable it. Volume MA, mine's the default 20. So this, what the moving average is doing right now is it's giving me the average of the last 20 candlesticks across the histogram. Basic stuff. Intraday, which we are not as a community trading, but intraday, this is important. Why would volume by time matter more intraday than it would from a swing trading perspective? Well, we're looking to hold positions for anywhere between 45 to 180 days out usually. Do we necessarily care what happens intraday? Ever? But particularly on a Tuesday at 1 p.m., do we care about what volume is doing? No, probably not. It's probably not influencing anything in our long-term goal. The position that we have probably is not going to be decided on intraday on a random Tuesday. So we can kind of overlook that. But why do day traders need it? Well, day traders need it because they need intraday volatility to move price around, and obviously that's where they need to operate. They need volatility intraday in order to buy low and sell high, or short high and cover low. They need that. We do not. So intraday volume does not matter as much to us or at all as it does to day traders. As a matter of fact, what you'll see a lot of the older school guys doing, they turn volume off. You don't need volume as a swing trader. You do not need volume as a swing trader. We have it because we play the BRB setup, but you technically, if you have the indicator installed correctly, don't even need your volume histogram on your chart. We're more about that overnight drift. We love the overnight drift. We play for the overnight gaps, and those gaps are not necessarily represented in volume on the daily candlesticks. You're absolutely right. On the right-hand side, we have VRVP. Mine's going to look a little different. So this is on circle. If you ever throw your VRVP indicator on and you don't know why mine looks different, all of this is copied and pasted onto circle. So you can go through and set it up exactly the way mine is. I have things like point of control off and a couple other things that I don't necessarily care about because I can see it. VRVP tracks volume by price, not volume by time. Both of these can be incredibly useful in certain instances, but the VRVP indicator is more useful for a swing trader, especially us, because we use it to identify potential areas of resistance and support. We can see as we buy breakouts if there's anything from the left-hand side that we should be worried about. If there's a lot of volume up here at the $90 area, for example, we might not be able to see it too well here, but we should be able to see it over here on the right, which we don't, by the way. Good. On the other side, when things are coming down, we have a better idea if there's going to be some underlying support at a certain level that we can test. For example, we can see that there might be a little bit of a volume node here, and so we can reasonably expect that if app pulls back at some point and tests 72, that we're probably going to find some sort of support here. If you were to just look at this fractal that we just broke out of, you might not be able to see that. So VRVP does a good job at allowing us to identify areas of the chart that have volume based off of price, not necessarily time. So what we like to do, or what we've been doing for the last 12 months, is identifying stage 1 into stage 2 breakouts. We've talked about this all the time. We can identify areas of accumulation through the VRVP indicator. We can see that there's a lot of volume coming in here. As a matter of fact, we know that a majority of the volume on the chart was at $40. $40. That's where most of the volume is at the price point at $40. So it's reasonable to assume that most people that bought this stock probably up double now. Congrats. So those are your two basic volume indicators. Those are the two that we use. We talked about how volume doesn't matter as much towards swing traders, but I'm going to back the bus up really quick. And I don't know. Let's use Uber, for example. Move into this direction. People, right now you go on FinTwit, anywhere, and people are going, I don't trust this rally because the volume is low. Volume is low. It is low. It's very low. And people like to say, well, I don't trust it because the volume is low. Well, the volume's been low many times before, and stocks continue to break out because it follows the general direction of the primary uptrend. Just like in a bear market, when volume gets really low, things continue to break down. The direction of the primary trend is more valuable than the volume that's going into it because of one key concept. Anybody ever heard of melt up or melt down? Mike was talking about it today in Discord. When people say the market is melting up, what they mean is we are slowly heading upwards on little to no volume. This is a normal phenomenon. You do not need volume to sustain trend. Doesn't matter if it's a bull market or a bear market. You do not need increasing volume to sustain trend in either direction. That is a fallacy that has, as far as I know, never been proven correctly. It's just one of those things that people go, well, watch out. There's not a lot of volume. Doesn't have any statistical edge whatsoever in terms of whether or not a trend is going to continue to go. It's this melt up concept or meltdown in a bear market. I think that's important to understand. It could go in both directions. So during the bear market, when people go, there's not a whole lot of volume in these sell-offs, maybe it's almost done. Well, we continue to go down. But where it does matter are pivot points. Pivot points tend to have a lot of volume. The bigger and more robust the pivot, the more volume. We can see here, this was the absolute low of the bear market. Big volume spike, but was it necessarily bigger than any of the other volume spikes over the last 12 to 18 months? No, not really, but it was noticeable. It was a big volume event, but it wasn't like knock your socks off, watch out. What was more important was the intraday price movement on that candle. For those of you that were trading during 2022, you remember this. Gap down huge and complete. That was a different looking candlestick. Everybody was looking at that like, oh shit. High volume, but it wasn't even higher volume than it was a week and a half ago. So once again, volume matters less to sustain trend, but it does tend to become important around pivot points. Uber. We're talking about potentially buying Uber, and we have over the last few sessions. What showed up at the pivot point? Volume. Do we need volume to sustain the rally? No, we don't. What we need is volume at the pivot point. It's generally going to be either buyers digging in, refusing for the price to continue to go down, reverse back to the upside, or sellers pressing their edge, buyers becoming exhausted, and then all of a sudden the price starts to come down. So pivot points are more important when it comes to volume than sustaining trends. All right? Second concept of where volume actually matters is during our BRBs, right? Our pullbacks. What was a recent pullback that we bought that was a BRB? Potentially Reddit, although it hasn't bounced yet, so this might be egg on my face later. But let's talk Reddit. Remove that because that never played out. Here's an IPO range breakout high. Now, how do we use volume? Well, first things first. Let me pull this up. Give me 1 second. Trying to find the right study here to show you guys. That one's going to be too hard to share in a webinar. Here we go. Bulkowski, thepatternsight.com. As Chuck just pointed out, I just posted a diversification paper with some stats behind it. It comes from Bulkowski. We go over Stanley Druckenmiller's portfolio, the way that we implement this idea. But Bulkowski also did a bunch of statistical work on volume. And in his statistical work for volume, he has it summarized here. And I'm just talking about breakouts here. That's the topic of discussion. An upward breakout on average or above average volume propels the stock higher by just 1.8 percentage points. So if you're inside of Discord, you know this because we were talking about it just a few sessions ago when there was a question about high volume versus low volume breakouts. Everybody that starts trading goes on YouTube, nowadays at least, and the first thing you see is don't buy breakouts that are accompanied by low volume. It is fucking wrong. That is statistically wrong. Upward breakouts average only 1.8% better than low volume breakouts. That's the stats. Are you going to skip a trade based off of a 1.8 difference? Probably not. You probably should not. Failures nearly triple after an above average volume breakout. Failures, meaning that the stock doesn't even continue to break out. It pulls back, which is where the crux of our BRB starts. That's where we want to be in, on that failure part. Price is 3 times as likely to throw back after an above average volume breakout. So once again, all of the stats show, you can go through here and read it on your own time if you want. It's also linked on Circle, that high volume breakouts only move on average 1.8% percentage points better than low volume breakouts, but they fail way more and they throw back 3 times as much. Once again, all of the guys on YouTube, and this is like trading 101, don't buy the breakout unless it's accompanied by high volume. When you actually look at the stats behind it, that is absolute utter trash. That now you understand it's just like an ad. It's like one of those things people can copy and paste and it can make you sound smart. But when you actually dig into the data, it's not smart. So what do? We understand that. Trends tend to trend in the direction of the underlying trend, right? When breakouts happen to the upside, they tend to continue to go. We can stack edge in our favor. We have momentum indicators. We have industry strength, sector strength, all of these things. But the basic tenet is high volume breakouts, which in this case it was. We use that moving average here to give us a general idea of whether or not it's a high volume breakout. But we also have the RVol here that tells us. So this was a high volume breakout. And then what do we get? There's about a 65 to 64% chance of a pullback over the next few sessions. There's the breakout. There's the high volume breakout. We identified it and it pulled back. There's a good chance Reddit is going to bounce. And not all of them bounce, but wouldn't you rather own it at 50 than at 55? I would. Contracts are cheaper. You get a better fill and you get to use the original stop, which means your risk to reward is going to be higher. This is where volume does help us. This is a statistical anomaly that not many people are using right now, but we are. I have no idea how long this edge is going to last, so use it. Mike has been trading with me for 4 years. Mike will go on record as saying the BRB setup is his bread and butter. It's made us together more money over the last 4 years than any other setup we have. It's the simple buying of the pullback on high volume breakouts. Remember that the direction of the underlying trend tends to prevail, particularly if we're stacking all of the other things in our favor. So you get these high volume breakouts. You can reasonably assume that there's going to be a pullback. Own it on the pullback. Do not chase it. There you go. That's one instance where volume does help a lot, is on the entry. But does it need to have high volume as it continues? Let's look at some of the names that we bought and continued to rally after we bought them. Look at all that volume. We bought the pullback on CART. What did we get through the entire move? Is that still high volume? No. App. We bought it on high volume. Did it still technically have high volume? No. Guys that are worried about divergences all the time would go, well, that's a declining volume through the continued move. And they'd worry about stuff like that. We don't worry about that because we know you don't need volume to sustain trend. You need volume to give you opportunities to enter a stock and at pivot points. So don't get lost in the whole volume idea that it needs to be persistent in order for you to be able to take a trade. Let's take it one step further. During consolidation phases, a lot of people sit there and say the stock is declining in volume and therefore there's going to be an increased chance of a failure. The statistics also don't show that. Now, this is not the best consolidation fractal. Why? Because there's a lot of white space. The best type of and the highest performing continuation fractals look more like this. There's very little white space. In App's instance, there is white space. Just something to consider there. It does degrade the performance of the breakout, statistically speaking. Having said that, what we typically see during consolidation fractals, and we went through this in the webinar on how to buy once stocks are already in stage 2. As stocks consolidate within whatever fractal it is, whether it's a bull pennant, a symmetrical triangle, an ascending triangle, whatever it is, you tend to see volume decrease. And at the apex point, volume spikes. That's what the stats show. That as stocks are consolidating, volume is decreasing. Now, let me ask you a question. How many of you guys have ever traded with Bollinger Bands? We're getting I'm showing my age here. Bollinger Bands measure volatility, right? One standard deviation away. When stocks come down and tap it, good chance they come back up. When stocks hit the top, good chance they revert back down, etc. Bollinger Bands. What happens when a stock that's in an uptrend all of a sudden starts going sideways? And those Bollinger Bands what happens to them as the stock stops going up and starts going sideways? They tighten, right? They get real close to price. The Bollinger Bands contract, and then there's a setup on that specific setup. I don't know. As the Bollinger Bands contract, you get something called a Bollinger Band squeeze. It's a violent breakout. We'll say it's in the direction of the underlying trend. And then what happens to the Bollinger Bands immediately? They spike huge. Price goes nuts, might come down, and then start consolidating again. But these things obviously contract with time. And then as volatility begins to wane again, they start to constrict again. So that's a real play. That was a terrible drawing on that second part, but you get it, right? As things consolidate, volatility contracts. Volume is the exact same thing, excuse me. As price contracts into these chart patterns that we can trade. And remember, chart patterns are not like, the best thing in the world. But what they do allow us to do is give us risk levels. And based off of previous performance, we have so many of these in the bank, we can get a general idea of what the type of performance is if they start to resolve themselves. So there's a million different of these types of breakouts that we can quantify and say on average these things are on 18.4%. So we have a general expectation. They don't have to. It's all averaging, right? But just like a Bollinger Band, constricting here, yeah, constricting, that's a great word to put it, and then bouncing, it's the same thing with chart patterns. As they consolidate, volume is going to be falling throughout the entire continuation fractal. And then at the apex point, you see a huge volume spike, and that's where you see the Bollinger Band spike as well. So once again, during continuation fractals, as price begins to constrict really tightly, it's not a run for the hills situation. As a matter of fact, assuming that they resolve in the direction of the underlying trend, the continuation breakouts perform better on average as volume decreases through the continuation. I would not be surprised to see app, recording this on May 9th, 2024, at $100 relatively soon. I wouldn't. It has all the hallmarks. Continuation fractal, gap up, post good ER, waning volume through the continuation fractal, big spike on the apex. So we can use volume in certain ways to identify opportunities in the market. We can buy the pullbacks. We can verify whether or not chart patterns are consolidating effectively or not. We can set expectations when we get resumations of those continuation fractals, and we can, have a general idea of maybe how high these things can go, at least off of this consolidation period. We can find support and resistance areas, but one thing that we don't want to do is fall into the trap that trends need volume to sustain themselves. It's such backwards way of thinking about volume nowadays. All right? You do not need volume to sustain trend. Low volume days are just as effective as high volume days. I want to open it up to questions really quick. If there's anything in particular you guys want to go through, or you want me to show you another example on things like chart patterns consolidating, I can give you another one of one that resolved to the downside here. Oops, not ARC. ARM. So we had a big flag on this, and it resolved to the downside here. And this was a loose chart pattern. So this is what they're called in, CMT and everything else. But loose chart patterns have lots of white space, right? So you can see white space, white space, white space, white space in this. It's not perfect, but generally speaking, when you read about stats behind chart patterns, there's an underlying assumption that most of these chart patterns look like this. There's very, very little white space. Loose patterns, which is what you would refer to as chart patterns that are continuation patterns, if you will, that have lots of white space, tend to perform worse than things like a high and tight, for example, which would, instead of this, would look something like this. Very tight, very little white space, not a whole lot of movement. In this case, it was a very wide range of price movement, lots of white space. Whether or not this was going to resolve higher or lower, just wanted to point that out. But what happened when volume or when this was consolidating for volume. Volume died down. This is what you want to see during a consolidation fractal. This one resolved to the downside. What happened after the breakdown? Volume spike. So volume came down, volume spiked. Everybody that was short made a bunch of money. There's the volume, or there's the pivot, there's the big volume. So volume can be beneficial in certain circumstances. Pivots, continuations, BRBs. Where it doesn't friggin' matter is continuation of trends at all. Which is why, like I said when we started this webinar, there's so many older school traders, particularly swing traders, position traders, trend followers, investment managers that have their volume histogrammed entirely turned off. They don't care because it doesn't matter anymore. Also because they're playing for overnight moves, not intraday stuff. This earnings season seems like playing roulette this quarter. Miss earnings, stock jumps, beat earnings, stock tanks, should be reducing ahead of earnings this season. Yeah, it absolutely has been a roulette. That's a great way to put it. 100%. Doesn't make any sense. I'm glad we avoided most of it. We didn't take a whole bunch of positions prior to earnings. You're absolutely right. But you're also right. It's been very random. So, any questions regarding volume? It's not the sexiest subject here, but it's important to break bad habits. And one of these bad habits is looking at something like a SPY or a Q and looking at the last two sessions and going, well, I don't trust it. Guys, nobody trusted it here. And look what happened. There's always a million reasons why you can be worried or should be worried about the market. Most of them are completely worthless. If the Qs reverse here and break back down, it has nothing to do with volume, at least statistically speaking. Cup and handle, I'll pull it up for you really quick. But you can also, I know you have this website. You can look at it too. So cup and handle is one of the most bullish patterns that you could be trading. It's a 3 out of 39. Bukowski loves these things. The best part about, in my mind, the best part about the cup and handle patterns are the fact that you have two entry points that you can play. You can either play the bull flag breakout or the lip breakout. And if you can front run that bull flag breakout, meaning buy it on the break of the flag, you can use that lip breakout as your first profit target. It's not even a minor profit target. It is. And you can move your stop losses up aggressively. So it's a very high risk to reward setup, your cup and handle. If it does break above the lip, you are now using the lip as your risk on level, if you will, but you already have a position. That's why I personally love cup and handles, and they do tend to do well, as Bukowski, at least within his realm, says 3 out of 39 for volume. Let's see if there's anything here that mentions volume. He doesn't have anything associated with volume on the cup and handle. He normally does. Or it was deleted, because I'm pretty sure there was something. Or I'm just not seeing it. Yeah, I don't see it. This has nothing to do with volume. I apologize for going off on a little tangent. But yeah, cup and handles are great. Absolutely one of the best bull market setups that you can trade. Like I said, there's two possible opportunities off the bull flag and then off the lip. It's good stuff. Also, for anybody watching this, if you ever want to go through any of the chart patterns, if you just go to the pattern site and then go to thepatternSite.com, I fully endorse it. This guy rocks. Chart patterns index. It's going to give you, it's look like it's built on GeoCities in 1998. That's how you know it's good. He has all the stats of basically every single chart pattern you can possibly imagine. He does all of this stuff for free and in his free time. So I encourage you to go and look through it. Or if you're on the trading development program side, go and watch the TA crash course. I have 17 hours of me talking about all of these fun chart patterns and talking through them and stuff. And it takes data directly from that website. So, okay, guys, it was a quick webinar, but I wanted to get it out for volume. That's all I can really think of in terms of things that we've used volume for. And I'm trying to break the myth that you need volume to continue trends and stuff. You just absolutely don't. It's less and less important as time goes on because of high frequency trading firms algorithms basically just trading amongst each other, maybe a little bit of wash trading, maybe a little bit of market spoofing going on for those older that remember what spoofing is. I'm sure it still exists in some capacity. If you guys have any questions regarding volume specifically that I didn't actually take, or I didn't talk through here, excuse me, feel free to leave them down below this video and I will answer them individually. I appreciate your guys' time. Hope you guys learned something, and I'll catch you in the next one.